Welcome back to Behind the Checkout. I'm John Lunn, founder and CEO of Gr4vy, and your host of today's episode, Where Are We with Pay-by-Bank Payments, aka bank-to-bank payments, account-to-account payments, or even open banking payments, and when will it become the norm? Today, we're driving into the fast-changing world of pay-by-bank payments, a space that's rapidly evolving thanks to real-time payment rails like RTP, PIX, and others. To help us unpack these questions, I'm thrilled to be joined by Alexandre Gonthier, founder and CEO of Trustly Inc., the global leader in pay-by-bank. With years of experience driving innovation in this space, Alexandre will share his insights on adoption challenges, fraud trends, orchestration strategies, and how we might eventually see pay-by-bank take the lead worldwide. Alexandre, welcome to the show. It's great to have you here.
Thanks very much, John. I'm happy to be here.
So why don't we start with the basics? How do pay-by-bank stroke open banking payments actually work? And how do they differ from a card-based payment or a wallet transaction?
Maybe if you don't mind, I'm just going to quickly talk about the naming because it's quite funny. There are so many names that people get confused. It started as open online banking enabled payments, OBAT. That's 25 years ago in the UK. Then there was the notion of open banking emerged, and it became open banking payments. Then bankers started asking, investment bankers started talking about account-to-account payments, which is true, account-to-account payment, or you mentioned bank-to-bank payments. And now there is this pay-by-bank term. Open banking payments is the same thing as online banking enabled payments, and then you move into what is the category. If it does not use the Visa and MasterCard or American Express rails, then how does it work? Well, it works from bank account to bank account directly with no third-party network in the middle. That's why some people view it as the account-to-account payments category. It's a bit limiting because account-to-account is also good old-fashioned ACH, or in Europe it would be IBAN payments or bank account sort code in the UK, without the notion of a new user experience that's enabled by online banking or now open banking at its core. Anyway, so pay by bank is the new term which seems to stick, at least in the US. It does not actually speak to the notion that it's open banking enabled, but that's really what people think of right now is next gen ACH, next gen bank account to bank account payments without going through Visa, MasterCard. So how that works next to Visa, MasterCard, again, you have every single country has a wholesale payments network that enables banks and now merchants, billers, and others to move funds from a bank account to another bank account. That's not Visa or MasterCard based. That's based on infrastructure that banks have been using for decades now to move money between themselves, between their customers' bank accounts. So we actually are leveraging the infrastructure, completely bypassing the Visa and MasterCard rails. That's what we do.
And I think the fundamental big change between this and ACH is this is, if not real time, it's close to real time, right? So I think we've had ACH for years, but that takes 3 to 5 days, if not longer. There's all kinds of issues around it, and it's never really been adopted in e-commerce as a way to make payments because it's too slow, right? And chances are by the time you find out if it's successful, your goods have already left your warehouse and are on their way to the other person's. The pay by bank, really the big driver here is it's near real time, as fast as a credit card, or not faster. And that has been the big change in my view. Do you agree with that?
Yes, you're correct. I mean, the notion of using ACH as the underlying infrastructure as a starting point for pay by bank or open banking payments is just that the network is incredibly attractive from an economic standpoint. So essentially, it's very inexpensive without interchange. And so, but the network has problems. It's batch oriented. The UX does not work in a web native, mobile native world where people don't know their bank account routing numbers. They simply don't. And so you have to solve for two problems, and that's exactly what Pay by Bank or open banking payment solves. So number one, you have a UX issue. The UX is if people don't know their bank account and routing numbers, especially when they're far away from their checkbook, so they're on the go on their phone, they have no clue. So they can now use the payment method. And and they used to know where to find that information. They no longer do. So first of all, you solve a UX problem by saying, well, if you know how to get into your bank account in your mobile banking app, typically it's a Face ID or it might still be a password from your bank, but that's something you do every day to check your balance. Everyone checks, stays close to their money. So people remember. And so you have the ability to do a UX paradigm shift where you move from having to fill out the form with information you don't know to simply doing a Face ID or signing in to your bank, just as you would do with PayPal. So that's the first. Signing into your PayPal account is the same notion of email address and password. That's the first paradigm shift. The second one is indeed fixing the blind spots of the current bank-to-bank infrastructure. And if your network is batch-oriented and it takes 2 or 3 days for the funds to settle, it's not acceptable to any merchant that needs to ship right now, or rather to consumers that expect the merchants to ship right now, right? So to solve this problem, you have two approaches. The first one, historically, there were no real-time networks. Did not exist. And still the ACH network is batch-oriented. So we actually, while we go in the consumer's online banking account, authenticate them to their bank, we also look at all of the risk attributes that we can see in their profile to decide, from balance to other attributes, to decide whether we're going to actually guarantee the funds in real time. If we guarantee the funds in real time, it does mean that the funds will move from the consumer's bank account to the merchant's account in real time, but it means that the merchant will know in real time that the funds are good, and therefore they'll be able to ship immediately. And that's important because, again, otherwise e-commerce is no fun, right? If you have to wait 1 or 2 days, even delivery now is same day or at times within hours. So that's what historically we've had to do, because ACH is and remains and will remain for years to come the most universal, the most available bank-to-bank payment infrastructure. But now you have real-time networks. And real-time networks, they have a fundamental benefit in that because you move the funds in real time, you don't have the risk of when you try to debit the account, there is no more money because the money has been spent in between using a debit card, right? Not that people are malicious, but if it takes 2 days for your account to get debited, then you made a transaction Friday night using ACH, the money only leaves your account Monday morning, then the whole weekend you can spend money without realizing. And so with real time, you eliminate that problem because you grab the funds in real time. So not only is it good from a risk management standpoint, and you can make now the funds available to the merchant also in real time, but it's a better user experience. That's fundamentally, you want to win the consumer, you have to deliver a better user experience. It's always the same thing. So we talked about the first one is UX paradigm shift. This is an experience, user experience shift as well, from having to, not with a debit card and a credit card. I get it. It works in real time. But with ACH, the good old bank payments system, it was slow. So now all of a sudden you can pay your bill and instantly your bill is settled. So that's essentially what we do to fill in the gaps, the blind spots of this aging yet incredibly useful at scale wholesale payment networks that you find in every country around the world.
Let's talk. We've seen major growth in real-time payments globally, right? So we've got RTP or FedNow growing here. We've got Pix in Brazil. We've got UPI in India and banking in Europe. What's driving adoption and what's holding it back? And then when I'm talking about adoption, I'm talking about merchant adoption. I'm talking about consumer adoptions. What is driving adoption? Is it being adopted on both sides? And if not, what's holding it back?
So you have adoption of real-time payments everywhere. Real-time payments are deployed. If you think about Europe, it's, at this point, I guess it's 15 years ago that the UK deployed the faster payments network. of course, it represents, I don't actually know the exact figure, but I'm prepared to bet it's 15 to 20% of the total the country's total bank-to-bank payment volume. Pix in Brazil has taken off over the past 5 years. In the US, we all think RTP and FedNow, but if you think about Zelle predates RTP and the RTP, the Clearinghouse Real-Time Payment Network, and FedNow. And that's the use case is person to person. Why people use real time? Because if you can have something right now, your money in particular, do you want to wait 2 days? No, of course, the user experience is just much better. It's much better. It's much better for a consumer sending money to someone else. And it's also better for a merchant that wants money right now as opposed to 3 days later. By the way, you look at the Visa, MasterCard rail still to this day. Go do a refund on an e-commerce site. You can pay in real time. They will grab the funds in your bank account in real time. No worries about that. But when you want your money back, and actually the retailer is in agreement and initiates a refund transaction, count how much time, how many days it takes for you to see the funds back in your account. It is not instant. It's not even overnight. So and it's very frustrating because what you end up doing as a person who wants to see their money is you end up monitoring, and every day you're going to check until you see that, because you don't want to forget and lose that money, right? So it's frustrating. And so real time, of course, comes with a huge advantage of like task. I have to do a task. I get it done. I can move on. It frees up mind share. It eliminates clutter from people's brains, right? Now, real time and non-repudiation, because these transactions, once the money is gone, it's not that you can get it back easily. It's like paying cash, right? The money is gone from your account. So you have liability around fraud. And who bears that liability? Banks wanted to say is the consumer, because it's non-revocable. That was the whole premise, right? But the thing is, if you do that, and then you have this older couple that get induced on the phone by a fraudster to send money to some bank account remotely to fund a great cause. There are always good stories that people are told to be defrauded, and that's called social engineering. And all of a sudden, what these people, they have lost money, and because the network is real time and they cannot ask for their money back. So the regulator or legislator in many countries, starting in the UK, because if you see when I said 15%, why is it not at 85%? If it's so superior, it's more expensive. That's one factor, because you have not had as much volume going through the infrastructure to essentially amortize, right? So you still have to repay all the original investments, but that's not the whole thing. The whole thing is that banks end up putting strong velocity limits. And the velocity limits, they shrink your total addressable market, as opposed to being able to address the entire set of use cases. They limit, because the legislator in all countries where real-time payments have been deployed says, well, the legislator people vote for laws that says that banks have got to stay on the hook in case of fraud, which is, fair enough. I mean, you're not going to ask this old couple to never see their money back if they were legitimately defrauded, right? And so you put velocity limits, and velocity limits, they say you can only move $3,000 a day, $3,000 in the aggregate a week, $3,000 in the aggregate a month. I'm saying 3,000 because I can tell you on the Zelle network in the US, try to use it to pay rent. Yeah, even if you're paying rent to someone who has Zelle, but absolutely it's not, because it's a consumer to business. No, it can be viewed as a P2P transaction. If you, in the Bay Area, there are not many places where you can live for $3,000 a month, right? At times it's $3,000 a week. And so that doesn't work on these networks. They put limits, velocity limits, and therefore it makes those rails unusable for these use cases. So that's the challenge, right? So you have these two dynamics: a great user experience, people want to use it, but on the other end of the spectrum, great user experience typically comes with more risk, and more risk needs to be risk managed. And the risk management approach is always velocity limits that puts constraints.
But we are. I mean, if the MRC published their fraud survey recently, a very interesting read, and reading through it, you do see the rise of pay by bank fraud as being across the world, and funny enough, in the US it grew the quickest according to their data. So this fraud, where's that coming from? How's that happening? Is this account takeovers? I mean, presumably if the merchants are seeing it, you would assume the merchants are legit, right? So how is this happening? How is pay by bank fraud actually happening when there's so much security around?
So your question is a fair one. I'm surprised that they speak mostly about the US. Fraud is happening right now in the US with Zelle, more so than anywhere else, because the other real-time use cases are, a business pushing money to a consumer and not a consumer paying a business. What is available currently at scale in the United States is from the clearinghouse or the Fed, is a business, an organization wants to push money to a consumer. That will be, a claim payment for an insurance company. There will be a government paying a per diem to a witness that has to go to court, right? That will a jury duty, whatever that may be. That would be, you understand. There would be emergency funds that are sent to someone by their insurance company. The ability to understand who you're sending the money to with that use case is high, right? Because you can say, I want the name on the bank account to be the same as the name that I know I need to send the money to. So you can actually, there is not a lot of fraud with this use case. The one that comes with fraud is the one where the consumer uses it's account takeover fraud, where the consumer uses someone else's bank account to make a payment to a merchant. They then receive the goods and the funds came out of someone else's bank account. But that would require that the US already had what's called requests for payments enabled across the board. But that's not the case at all yet. We're just at initial piloting stage. And there are very specific reasons that I can explain if you're interested. So Zelle, I can see in the US, there will always be a little bit of fraud around the payouts. Now, in other countries where you already have the ability to pay the merchants, because now people in the US are obviously starting to use Zelle also, even in small businesses, small restaurants will say, hey, if you want, you can pay me. Here is my phone number. You probably start seeing a little bit of that fraud as people are starting to kind of expand. This is really a P2P solution, but a small food truck, they have no problem or accepting a payment by Zelle. Why not? It works very well. You just have to enter their phone number, mobile number into your app, and you can pay. So maybe that's where it is. But again, sorry, I went back to the original Zelle scenario. Fraud will happen when a consumer pays a business. Yeah. It's not the case in the US yet, but yes, as usual, when the funds are not easily recoverable, when you can move them in real time, I have seen firsthand some scenarios where people, here is a typical fraud scenario that we have seen and blocked, since people will use an ACH, a regular bank account, and try to make a payment with ACH to make us think that the account is funded, that we can approve in real time. So they put money in the bank account. And within minutes of making the payments with us that we have approved and told the merchant, yes, go ahead. Then they use Zelle to move the money out. It's just like a debit card, right? So, but this is leveraging a payment rail, Zelle, again, to defraud, to essentially benefit from this is not even an account takeover situation. This is a mule. This is a real consumer that participates in a scheme led by organized crime, right? Where you have lots of small people, legitimate people who actually defraud you. And because each amount is small enough, it makes it impractical to go after each of them individually. Yet they have defrauded you of hundreds of thousands in a weekend.
Yeah. So there's one of the things that interesting to see is like there's lots of brands and where the brand sits in a pay by bank transaction, right? So I mean we work with many account to account payment systems around the world, but there always seems to be a little bit of a confusion from a consumer perspective on the branding, right? So I want to pay with my bank, but I see Trustly. What is Trustly? What is one of the other ones, Zepto in Australia, or Banked in Europe? Like, as a consumer, is there a need for a logo? Is there a need for like a card brand or something that you can stick out there to point this consumer at the brand if they want to pay by bank, but they don't know that brand?
Yes, at some point, there will be a unifying brand that people will recognize. Visa did not start as Visa. Visa came years later. It started as Bank AmeriCard. So it was Bank of America that had the first credit card. Anyway, the point is it takes enough adoption, enough volume to start looking for interoperability across rails. Visa, MasterCard, they were not interoperable day one. It came, with time. The same will happen here. You're right. Right now, the way to get consumers is to put a name in front of them that they recognize. The brand of the company processing behind is starting to emerge. But if you lead with it in a space where you're forming your habits, you're going to essentially hurt. You're going to curb conversion as opposed to helping it. Because people don't want to use no one is going to use something they don't know when it comes to their money.
So how do we get, it seems like a bit of a chicken and egg at the moment, right? So when we at Gr4vy, we talk to merchants, we talk to them about accepting, every payment type they can, right? Whatever the consumer's asking. And they're always saying, we need consumers to want this payment method or adopt this payment method before we add it. But again, chicken and egg, if the consumer doesn't see it, they're not going to adopt it. So how do we get over that hump? How do we get merchants to start accepting pay by bank by default? And how do we get consumers asking for it? What do we need to do here to drive this as one of the main or primary ways to pay?
I would step back and say for some use cases in some vertical markets, it's already the number one way to pay. You take Verizon, probably already, it's over 50% of their total billing volume. And you have some vertical markets where it's inexistent today, e-commerce. So why? That is the right question. Consumers are perfectly satisfied with Visa, MasterCard because wherever they go, they have their plastic cards if they still have them in their wallet, which they always have with them. And if they like me, I don't always carry my wallet these days. It's a virtual, it's a digital version anyway in their Apple Wallet or other mobile wallet. So you have to understand that you're dealing with a situation where cards work well. But merchants pay a lot for that product that consumers have grown to use more and more and more. And they pay a lot. Why do they pay a lot? They pay a lot because consumers are incentivized to use their Visa, MasterCard cards, right? Whether virtual, plastic, or virtual. How? In the form of loyalty points, cashback programs, all of the rewards that we know are attached. Now, they're not attached to debit cards, they're attached to credit cards, granted. But then there is a brand association. Visa, MasterCard are incredibly well-known, well-established brands now. So the merchant is the one right now who's essentially suffering because every year interchange fees, the fees that merchants have to pay for every single Visa, MasterCard, American Express transaction to get processed, it doesn't go down. You would think, right? As the market gets more competitive, with more volume, no, it goes up. It's reverse gravity. It's fantastic. It's the best, the single most intelligent business model I I've ever seen in my life. More competition, higher pricing. Amazing. And so merchants, if you operate like a grocery chain on 2% pre-tax profits, 2%, and you have to pay Visa, MasterCard 1%. Imagine what you can do to your shareholders if you added 1 percentage point to your 2%, you increase your bottom line by 50%. The impact on the share price is insane. So insanely positive. And so merchants have a very strong vested interest to try and get consumers off of Visa, MasterCard. So you have to start with merchants because they are no matter what, the marketing, the payment lineup is controlled by the merchant. And if it's not the merchant, it will be Gr4vy as an orchestration layer. But that payment lineup, merchants have an incentive to want to put you as a lower cost payment method first. And if they can, pre-select it, right? Now, let's step back for a second. I'm starting to give you an answer on the person the stakeholder that's the most motivated is the merchant. But if we step back, because I'm already getting into the retail space, but if you step back, we talked about Verizon, we can talk about AT&T, T-Mobile, Charter, all of these very large billers. It would be the same in the insurance space. It would be the same in the property management space. It would be the same in the government space. Everyone knows when you want to pay your taxes, try to pay with a credit card, plus 3%, plus 4%. There is a reason. It's because it costs them a lot. They are vertical markets where paying with your bank account is still the historical habit that's hard to kill. It used to be that 90% of an AT&T's bill pay was bank based. And what happened when the mobile phone emerged? People on the go, they started very simply having to, pay a bill while on the go. And so all of a sudden, what's with you on you, like you have your wallet, you get your debit card, you get your credit card. And the mobile device essentially caused a huge shift of consumer behavior from paying by bank for bills to paying by card. And so these people suffer. And now they pay, we're talking about, in the aggregate, these billions, just billions and billions of dollars, right, being paid to the Visa, MasterCard value chain. So these people who historically have always paid by bank, either it was a paper check or it was going to overtime to their online banking site to do bill pay, and that there was a company 25 years ago, Gr4vy Corporation, that was doing that extremely well, connecting all billers to all banks via their platform. A lot of them, maybe they're 35 or 40 and older, they're happy paying with their bank accounts because it's recurring bills. I'm on auto pay, I'm happy doing that. So we have to realize that there is still 20 to 50, 60% of the total billing volume, depending on the exact biller, that naturally can go to bank payments, to pay by bank. Naturally, especially, so it's not so always so natural, especially when billers now are offering discounts for paying with their bank account. So now we get into the incentive game where they want people, look, a bank account is evergreen. Unless you have fraud and you need to close your account and open a new one, is evergreen. A credit card expires every 3 years, and then you have all the auto update issues, or it gets closed because your bank detected some fraudulent activity or suspicious activity, and just suspicious activity causes them to literally block your card. And then you're in trouble with all the billers where you have your card on file. Bank accounts are evergreen, so there is a reason why it's churn proof for a biller and lower cost, as we said. So they will give an incentive. They want people to be on auto pay and set and forget. So they will pay people, and people respond well to incentives. So we prove that very clearly in the biller space. And so if you have a merchant that, first of all, is interested, has a vested interest in getting you to move to to ACH in the broad sense, right? Or pay by bank. Two, with that, they will put you first in the payment lineup, or they say, hey, I'm going to actually give an incentive for you to do that. Then you can start reprogramming people's behavior. And that is what's going to be required in retail. Amazon may be one of only 2 or 3 retailers in the US offering what I would call standard ACH, e-check, enter your bank account routing, not even open banking payments. And of course, so their share of checkout, what is it? Is going to be 1%, 0.5%. I don't know for a fact, but I'm prepared to bet. And so if you charge the UX and if you start putting an incentive in place for people to do it, you will have adoption. If you don't put an incentive structure in place, why would consumers walk away from something that works if you don't give them debit cards, credit cards, if you don't give them a reason to?
Exactly.
So let's say, for instance, in the donation space, I give you another example. We've not talked about that. The nonprofit space. The nonprofit space, I experienced firsthand. A few years back, we went live with some of the largest nonprofits, and we didn't know. We didn't know what kind of marketing message was going to drive consumer, drive their behavior. And so we just started by explaining, pay with my bank, adoption level, 5%, share of checkout. And people were using us to make $50,000 donations because you cannot do that with and so where cards were limited by their own velocity limits. And then we realized that if we wanted to get also $50 or $5 transactions, we had to use different messaging. And so we went from generic, explaining how it worked language to, more of your donations, more of your donation dollars, more of your donation goes to United Way when you pay with your bank. And we went overnight from 5% share of checkout to 25 overnight. So you have to think, you have to give people a good reason to do what you want them to do. I think we'll not do it. They stick to old habits, and good for them.
So at the moment, so we're a global company. We work with merchants around the world. We work with many different pay by banks, but they all work completely independently of each other, right? At the moment. So whatever system you have in the US and in Brazil and in Europe and in Australia, an Australian can't use pay by bank in the US or in Europe because the Australian pay by bank solution works for Australian merchants in Australia with Australian bank account. Do you see someone sticking this all together? Do you see it? Truly to compete with a Visa and MasterCard, you need a global network. Is that on the horizon?
It is on the horizon. That's exactly why I would say the first step in this direction was forming Trustly as a combination of a US entity and a European entity that was present in 25 countries, 30 countries, and we in the US, in the US and Canada. Now you need to add many more countries to cover the world, but that was the first step in the direction that you're describing. I tell you what, there is a need for it will come just the same way Visa and MasterCard are virtually everywhere now. It will come organically or inorganically based on, we're gonna have to interconnect with other domestic players in different geographies. However, the payments method category, if you will, is in its infancy. And before you go international, number one priority is actually to really build scale in your own domestic market. So, Europe, US, you can see you have a number of brands that kind of are very, very large in Europe and large in the US and conversely, but even then, I will tell you that the US market we're just scratching the surface. So why get diluted, distracted? When the name of the game is to take share from the incumbents right now in the US and in Germany and in the UK.
So I'll ask this question. I think you've already answered it, but I'm going to ask anyway. So what's next? What's next for Pay by Bank? What's the next 3 years look like?
Look, the first thing is adding real time to the infrastructure wherever possible. In the US, it's still in its infancy. I think it's a huge user experience booster. Second, it's incentives. You have to we have to replicate, if we want to get into retail, the Target Circle card model that says that you get 5% off if you pay with a given payment method. And it's not just Target, or it's Cumberland Farms. Others have figured out that if you give people a meaningful cashback program, they will actually pay not with Visa, not with MasterCard, right? So that's incentives are another, in my opinion, fundamental requirement as part of loyalty programs to drive adoption outside of the market, the vertical markets where pay by bank adoption is natural. As I said, the biller space in a very broad sense, it's a huge space, but it's not retail. And I think as a three, there are things that we can do with the bank rails that you cannot do with the debit rails, with Visa's debit rails. I'm going to give you a very specific example, and that's going in the direction of helping paycheck to paycheck consumers. If I know that someone on Friday night is at the pump putting gas in the tank, or at the supermarket buying food, and they want to spend $80 and they have only 50 left because it's whatever, the 27th, the 28th of the month. So if your Visa debit, MasterCard debit, the logic in your network is you decline. And so you have that person who's, at the cash register, and the conveyor belt, is full of goods, and boom, they can't pay, they get declined. So it's an embarrassment and it's a loss of a sale for the supermarket. But that person is getting paid on Monday. So why decline them if you can tell that on Monday they will have money in the bank? So what we're working on is precisely saying, no, we can see, because we have this open banking advantage, open banking data advantage, we can see they will be paid on Monday. We will approve them. We will approve them and collect not the same day, on Monday. So we can start giving, you can call that the extension of a little bit of a rescheduling, of scheduling, of optimizing when you debit the consumer's bank account, so that if you need to give them 2 days to say yes, you're going to give them 2 days to say yes. I think this is the third dimension that's really going to be a game changer for Pay by Bank.
Absolutely. Well, we're out of time, but thank you for your insights. Really appreciate it, and looking forward to working increasingly more closely with you at Trustly. So thanks for your time today, and let's leave it there.
Super, John. Thank you very much. See you soon.
See you soon.
Bye.